Welcome back to Morning Markets on Thursday, the 18th of February. George Bell here, investment analyst, to bring you up to date on the key market moves over the last 24 hours. Looking first at equity markets here in the UK, you had the FTSE 100 down 71 basis points yesterday, FTSE 250 down 1.25%. In the US, you had the S&P 500 down 3 basis points, the Nasdaq down 58 basis points, and the Russell 2000, which encompasses a greater number of companies with a smaller market cap, down 74 basis points on the day. In Europe, you had the Euro Stoxx 50 down 71 basis points, and across in Asia, in China, you had a strong reopening as markets opened back up after the Lunar New Year, but did pull back some of the gains on the day. Shanghai Composite still closing up 55 basis points on the day. Japan, in the Nikkei, down 19 basis points, and in South Korea, some more pronounced move. You had the Kospi down 1.5% as the country continues to battle with rising infection rates there. There are a number of reasons for the moves which we're seeing in equity markets on a regional basis. A key factor in focus at present is the movement which we are seeing within the bond markets reacting to data, policy information, and inflation expectations. In terms of data, here in the UK, yesterday we had reports from the Office for National Statistics, which highlighted the annual rate of inflation measured by the CPI rose 0.7% in January, up from 0.6% in December, a reading which was actually ahead of the analyst expectations of 0.6%, despite the tighter lockdown measures being imposed. The biggest contribution to the rate coming from furniture and household goods, but also hotels and restaurants, which may seem unusual given the current lockdown environment, but closer observation highlights that fewer businesses operating within the leisure and the hospitality space applied the usual January discounting technique, so you have a year-on-year effect there. The yield available on 10-year government bonds continued to push out, reaching 0.634% by midday, and the 30-year back out to 1.23% before coming in 5 basis points and 7 basis points in afternoon trading, following comments from Bank of England Deputy Governor Dave Ramsden that the Monetary Policy Committee could review the constraints or the guide rails which they have imposed around the purchasing of bonds. So in other words, they could look to increase the size of the existing quantitative easing package further. Just to give you some context of the scale of the package, the current target, which was extended by 150 billion in Q4 last year, is 895 billion pounds. So they're purchasing 4.4 billion pounds worth of bonds each week in an effort to defend the economic challenges of the virus. During the meeting, Mr. Ramsden also took the opportunity to reaffirm the bank's commitment to a 2% inflation target in defence that concerns of the central bank was simply financing the government through the purchase of bonds, pointing to the current market implied inflation expectations, so looking at the break-even rate, which is north of 3% at present, as a barometer of belief in those comments. He also reaffirmed the view held by the markets that the MPC had effectively taken negative rates off the table for the time being. Keeping on the theme of central bankers across in Europe, yesterday we had the former European Central Bank President and new Italian Prime Minister Mario Draghi in his first speech since being sworn in on Saturday. In his speech, he reaffirmed his desire for greater unity within the Union and commitment to use the next generation EU budget, so around 210 billion euros, to invest in infrastructure and bring about legal reform to drive growth in the country. The confidence in Draghi's ability to bring about positive change in the Italian economy is reflected in the yield spread between Italian and European benchmarks such as the German Bund. The spread has continued to pull in since the start of the year, reflecting the lower perceived risk of holding Italian paper. Across in the US, from the Census Bureau, we had demonstration of further strengthening of US retail sales. Total sales increased 5.3% in January when compared to the month prior, beating forecasts of a 1.1% increase. Consumption was supported by the government support packages as US citizens went out to spend their $600 checks. The biggest beneficiaries were electronics and appliances, up 14.7%, furniture and home furnishing up 12%, and consumption from retailers with a purely online presence up around 11%. The US dollar strengthened 0.3% on the day on a trade-weighted basis. That's all for today. We look forward to bringing you up to date tomorrow. Thank you for watching.
Thanks for watching. If you enjoyed this video, please leave a like and don't forget to subscribe to the True Potential YouTube channel. If you have any questions or requests for future videos, let us know in the comments.